Hi, I'm Greg Corombos. Welcome to Banking Compliance Insights by Wolters Kluwer, a podcast series from Wolters Kluwer. This series was created to deliver insights on compliance trends and strategies for navigating today's regulatory and risk environments. Today's episode, Fraud Opportunists 6 Feet Away and Closer Than Ever, will focus on trends creating opportunities for fraudsters, including a few driven by the pandemic, regulatory oversight measures, and strategies for shoring up fraud prevention programs. Here to lead our discussion on this subject is Wolters Kluwer Banking Segment Leader Samir Agarwal, and he is joined today by Gary Schweers, a senior regulatory consultant with Wolters Kluwer, to provide expert insights on these challenges. Samir, let me pass the conversation over to you.
Thanks, Greg. Today, more financial institutions are partnering with Fintechs out there, and they're conducting transactions digitally due to social distancing requirements or any brick and mortar branch closures. This is a really fast-paced move, and the digital environment has created a new breeding ground for fraud opportunists. I've invited Gary Schweers, a consulting manager with Wolters Kluwer's advisory team, to share some of his observations about the current environment. What our listeners and I want to understand are what are the strategies for getting in front of the emerging risk areas, and how do we manage them? Gary, welcome. And please give us some of your insight into what you do at Wolters Kluwer today.
So, thank you, Samir. I appreciate it. I'm Gary Schweers. I'm a senior regulatory consultant with Wolters Kluwer, like you said. And we work with bank clients and fintech clients to help them ensure they have the compliance management systems and the BSA AML policies and procedures that they need in place to make sure, one, they stay out of trouble with the government, two, that they reduce fraud and risk within their own portfolios, and then three, serve those customers that they need. So whether it's the bank or the fintech partner or their ultimate customers, make sure that they're getting the products and services that they're trying to deliver.
So one of the significant legislative initiatives out there in the CARES Act, which created the Paycheck Protection Program and soon intended HEALS Act, is something I want to kind of cover with you real quickly. Money is set aside in both those programs for qualifying small businesses to support small businesses during the pandemic. And ultimately, it's providing protection for millions of American jobs. Gary, what's your take on the situation now, and how do you see that these funds are designated to provide relief?
Well, so first, let's kind of talk about the population, Samir. So the government issued over $4 trillion in stimulus in 2020. And some of that went directly to states and cities and hospitals and things like that to help support, the issues that they're having. And then other parts of that went straight directly to people for unemployment or for just straight stimulus checks. But a lot of these programs were put together super fast and with changing requirements while they were being set up, and some had very ambiguous standards. But under the Paycheck Protection Program, or PPP, the government has issued about $659 billion in loans that go directly to support small businesses and the jobs that they have in everyone's communities. The PPP loans were made to businesses of all sizes, and the purpose, like we said, is to support continued payroll and jobs. These loans are forgiven by the government if the criteria set by the government was met, mostly that the majority of that loan was being used for the payroll of the business. So of that $659 billion, that's about 5 million loans that were made, and 86% of those loans are about $150,000 or less. So it really was designed for and intended to support small businesses. So hopefully most of those funds are going for those reasons. But of course, with that big of a pie, there's always going to be attempts for fraud.
So how do we ensure money is used in the intended way? If we're lenders or supporters of the transaction, we want that money to go into the right hands and used in the right way. How does that occur?
Well, there weren't a lot of standards set out by the government for what the banks did need to do to ensure the funds were used in the right way. It's a lot of attestation by the borrower on their part to ensure the funds were used in the right way. But like we said, with that big of a pie, there's opportunities for fraud. And so the first day you could actually get a PPP loan was on April 3rd of 2020. And the first announced fraud that was being investigated by the Department of Justice was on May 5th. So it took a month for, some kind of fraud to pop out immediately to the government.
Can you give us some examples of the types of fraud that have come out since the program started?
There's been about $1 billion in reported investigations going on with the Department of Justice and other government agencies at this point. But that first one we talked about that was brought up on May 5th was two guys in the Northeast, and they got a loan for just over $500,000. They had listed 4 different businesses on their PPP application. None of these businesses actually had any employees. And actually, the big red flag was all these businesses were started after the pandemic. So there was a red flag there for the bank and others to see, but apparently it got missed.
Did it matter what type of business they were, or was this red flag simply because they didn't meet the criteria of having an established business with profitability?
It's not so much profitability, but it's just really that there weren't any employees for the payroll protection program to be paying. So the red flags were there potentially for the bank to have seen. There's another example that I'd like to share with you. I think it's kind of interesting because it occurred where I'm from in Texas. It was for a barbecue place that, and the loan was just for under $1 million. But all that actually existed was a website for this barbecue place. You couldn't even, order it online. No physical location and no employees. But the red flag that came out of this one was the credit union that took this loan application started asking some questions, and the applicant was asking about paying his employees with cryptocurrency. And then it turns out the guy actually took all his PPP funds and invested it in cryptocurrency for himself. People have bought Rolls Royces and Lamborghinis with their PPP funds, clearly not payroll related. And even sometimes there was a unreported guy that took all his PPP funds straight to the casino.
So, it sounds really exciting, I guess, from the start of the transaction. The government's paying the lending institution quite a percentage point for just making the loan. And then the repayment is at a fixed rate that's very low, too. With each one of these situations, do you know if there were brand new clients to that bank, or were they clients that banks had already done business with?
The Department of Justice didn't disclose anything like that, but the government did have some standards that they stressed for banks that were dealing with either existing clients of the bank or new clients of the bank. And they really stressed that those BSA and anti-money laundering standards of beneficial ownership and due diligence on those new customers was very important. And apparently with the stress of the PPP loans being done in a very short period of time, bankers and credit unions working very hard to make sure that those funds were actually distributed, some of these red flags obviously got missed.
So what should have happened in both the credit union and the bank example that you've given us?
The government didn't really place a lot of standards on the banks to investigate these things. But clearly, if you've, like in the first example, if they're saying they have dozens of employees at these 4 companies that they just started, that doesn't make a lot of sense. Or this guy that just has a barbecue joint that only exists, as a web page, the banks could have potentially seen these issues. They should have been doing their due diligence that they would have done for any customer, not just a PPP customer.
Let's talk about potential fraud in the program. Are there any estimates out there that kind of dictate how much of the $659 billion might be subject to fraud?
As I said before, the government reported they're investigating at least $1 billion in fraud. And those are the blatant cases. Those are the easy targets that, like we've said, these red flags are just sitting there for you to see. But imagine if that criminal was more sophisticated. They could make it much harder to detect and even prosecute. So I've seen estimates from some fraud experts saying it's $10 to $20 billion. That's a lot, And just think of all the time and energy and money that the government's going to have to use to pursue those fraudsters and prosecute them. It's a lot of money.
Yeah, it's going to be well above that estimate of just the transaction for fraud. So let's talk about that further and get into the impact of the pandemic on how we do banking and what the expectations are, specifically to relationships that banks have with customers and then how to prevent fraud or how to really identify it. Before the pandemic, we're also facing a generational shift that I feel is accelerated now with digital banking. Right, the client base has been getting more comfortable with computers, mobile devices, and online banking applications. And now with the pandemic, it's almost like we've added fuel to the fire. How's that impacting fraud? And are there tools and other things that we need to kind of look out for how people transact today?
Right, Samir. So I definitely understand the part about the generational thing. So the other day, my 25-year-old daughter asked how to write a check. She had never actually written a check before, but she does know how to use Venmo and other electronic wallet type things. So she doesn't have a problem spending money. It was just the old way of doing it didn't compute in her brain. So, but banks are having to adapt to these new expectations of everyone wants it fast, easy, immediate, all those kinds of things. So with the potential for fraud being increased with those expectations, banks and their fintech partners, if they have those, are having to have more sophisticated fraud technology, use of various types of products that help them identify the customer, and not only identify the applicant that they're talking to exists, but is that actually the person that they're talking to.
Let's dig in just a little bit and talk about the steps that are involved. When we think about check fraud, it's pretty easy. Someone's looking at the person writing the check. They're taking a driver's license number or other security information that they're validating on the spot. When we translate that into digital banking, what are the verification processes that take place?
So in the absence of that face-to-face interaction, banks and fintechs are utilizing more sophisticated software and verification systems to ensure that they're dealing with the person whose name is on the application, and that they're going above and beyond what maybe a traditional bank would do for knowing your customer. So they're not just getting a driver's license, but they may be verifying your data through 3 or 4 different systems, 3 or 4 different databases, including cross-referencing your names, dates you've provided, bank account information, even geolocation of, you say you're applying in Austin, Texas. Is the geo information from your computer telling me that's where you're really sitting at right now?
Makes sense. And I guess there's a lot of security that's involved with that. And it's pretty neat technology.
Samir, one of the funny things, though, is a lot of these high-tech companies, even with the sophisticated tools and everything that they have, they still usually have an old school process where they might just still get a driver's license or some other documentary verification. Even if it's on an exception basis, sometimes they still have to revert back to the way it used to be.
So with the bank being the ultimate responsible party for that control, are there any recommendations that you would suggest to our listeners about what are best practices, right? How do I make sure that I know who I'm transacting with?
While the sales involved with these fintechs and, other opportunities are really exciting, the controls are boring, right? But they still have to be in place. And it really does still go back to kind of that old school. What is my culture? What's the tone at the top? And that's not just in words, but that's also in action. And that action is, providing the resources and the tools that are needed. And it's also the board and management paying attention to those items and not just giving that, lip service, but actually making that a part of your company, your bank or your fintech, whichever one it is. Another thing is actually living working policies and procedures. Like we said, these things are complex and fast. So you need to make sure that you are getting that CAMP information. You do know your customer. Also, if you're dealing with merchants, you need to know your merchants because they can commit insider fraud as well. A third thing is experience and knowledgeable BSA and fraud staff. We see a lot of fintechs that somebody gets stuck with this job, or, hey, this guy worked at a bank before, let's make him a BSA officer. And that's not a great approach. You can find experienced people that know what they're doing to help protect the bank or the fintech in the processes.
I'm curious, as we kind of look at experienced, knowledgeable individuals, does technology play a big role too? Like, do these individuals need to have familiarity now since everything's digital?
Definitely. Part of that is, based on maybe the systems you're using or the monitoring tools you're using. So say, for example, you're a credit card related fintech and there's hundreds of transactions that might process through your system. You have to have the tools that will help you identify issues, but you also have to have people that are knowledgeable about that tool, how to set it and calibrate it for your particular company, and then how to use that data.
The best way to describe what I'm hearing from you is these controls are extremely important. and they enable the bank to make safe transactions. No matter how exciting or how profit laden some of these transactions are, the controls are really enablers for making sound decisions. Is that right?
Definitely. Or at least help you hopefully not make the wrong decision.
So let's get back into the fintech world and how all this relates into the bank partnership with fintechs. What's the volume of transactions that fintechs are responsible for?
So here at Wolters Kluwer, we work with some very large and some small fintechs, but the volumes can be huge. We've worked with some fintechs that have made billions in dollars in loans to millions of customers out there, and they work with thousands of retail merchants. Most of these transactions are applied for and approved in minutes, if not quicker. And so it's really critical for those controls to be in place with that kind of volume and speed. Most banks aren't set up for that kind of consumer volume. And so when they particularly work with these fintech partners, they have to make sure their systems are ready for that.
What are the consequences if we don't adhere to those controls?
Well, definitely one, your program can overwhelm you with the volumes and with the amount of data and the requests that are coming through. But the banks have to have those operational controls and that infrastructure in place to not only fund these loans, but to then monitor those transactions and report suspicious activity that could be required under your BSA programs. The government, could potentially fine you. There's memorandums of understanding where they would make you put in other operational controls and things like that. Most of those times, those are problems that you don't want to have and face. So setting your controls and your operations up to begin with in the way that they should be is really critical.
So how can we protect ourselves?
Well, like we discussed, the volumes can be overwhelming, Samir. And those banks have to be ready with their operational controls and their infrastructure to handle that volume. Most banks aren't set up for this consumer transactional volume. They have to have those controls in place to not only fund the loans, but to monitor the transactions and report suspicious activity related to that.
So let's get into a little bit more about the AML side of it, or the anti-money laundering side of this, and what the regulatory expectations are during the pandemic. Are there heightened expectations around this, or what else have you heard on the street or with clients that can help us be more informed on how regulators look at fraud management?
So just the other week, I was at the Dallas Area Compliance Association meeting where they had a regulatory examination panel from all the agencies speaking about consumer compliance issues and BSA AML issues. And their main word was they're not changing their exams and they're not being tougher right now, but they're not being lighter either. But their expectations are just as high as they ever have been. And the way they're approaching a lot of issues that they're seeing now is through kind of change management. So if your program was weak already and now it's in trouble further because of remote working or inability to monitor things because of the pandemic, they're approaching that through change management and the issues around that in their examination reports. So it's not that their expectations are different, it's just they're not going to be easier because of the issues going on in the world. Their expectations of your BSA program and your compliance program are the same as always. They want those core tenets covered, in addition to what you may be having to add on top of that with maybe you need more staff at this point, or maybe you need a little extra time to review things, which they are allowing, but you still just have to make sure the program's operating as if nothing else in the world was going on.
Are they saying anything else other than just changing the organization?
FinCEN has put out some advisories related to imposter scams and money mules. And they also have some requirements around what you include in your SARS or your suspicious activity reports if you think it is coronavirus related. The government has issued some advisories on those kinds of things.
What do we see is the future for fraud management? Do we have new entrants that we need to be worried about, or is it going to be more of just strengthen what we already know?
So probably the biggest thing for banks and compliance people out there is the introduction of cryptocurrency into the world and into the banking system, and maybe frauds around that. The Office of the Comptroller of the Currency, who regulates national banks, just issued interpretive letters expressing that banks can custody crypto assets for customers and provide banking services to crypto-related businesses. And maybe you could have done that anyway, but now it's official that you can do those things. So that introduces a whole new world of transactions that people want to not be traceable and those kinds of things into the banking system. So that's definitely what's coming in the future.
What else, Gary, can Wolters Kluwer do to help clients maintain vigilance during this time? Where do you see KYC, BSA, AML, and also in terms of crypto becoming more of a focus point for lenders?
Well, so as we mentioned up front, Samir, I'm a member of the Wolters Kluwer Advisory team, and we help clients by conducting CMS, BSA, AML reviews, risk assessments, and we can also work with fintech partners. So definitely, like we had said, one of those controls earlier is audits and reviews. We'd love to be able to help clients with those kinds of things going into the future.
Great. So, Gary, it was a pleasure to speak with you today. And I'm really happy to hear that at least we have a few teams out there doing health checks for institutions that require them. It's definitely a fast-paced environment. Everything is going digital. So thank you for joining us. And it was really good to hear your practical suggestions for all of our listeners today.
Thank you.
That's Wolters Kluwer Banking Segment Leader, Samir Agarwal, joined by Gary Schweers, a senior regulatory consultant with Wolters Kluwer Advisory Services Practice. Wolters Kluwer is the host of this podcast and a market-leading provider of advisory services and technology solutions for optimizing compliance and risk management programs. For more information and additional guidance, please visit wolterskluwer.com or call 1-800-397-2341. Please join us for future podcasts focused on navigating emerging trends in regulatory compliance.